Lessor Accounting. So in Lessor Accounting, as we said during our introduction, that your lessor accounts for an operating lease and a finance lease. So if you remember, in your lessee, we generally account only for a finance lease. We recognize a right of use of asset and a lease liability. However, in your lessor accounting, it is proper for you to recognize a finance lease or operating lease. So you need to classify it. You classify it as either finance or operating lease. So to properly classify it, we need to know what is a finance lease and what is an operating lease. Let's start first with a finance lease. What is a finance lease? A finance lease is a lease that is classified wherein there is a transfer of substantially all the risks and rewards incidental to ownership of an underlying asset. So if there is a transfer of ownership, whether it is an actual transfer or maybe a transfer at the end of the lease term, we call it a finance lease. Later, we will discuss what are the indications for a finance lease. Okay, so just take note, if there is a transfer of the risks and rewards of ownership, that is a finance lease. How about an operating lease? An operating lease is given a residual definition. When we say residual definition, if it does not come off to a definition of a finance lease, therefore it is considered as an operating lease. So in this case, if there is no transfer of ownership, then we consider it as your operating lease. When we talk about transfer of ownership, what we transfer is the risks and rewards. Okay? The risks and rewards, not exactly the ownership or title at the time of the lease, but the risks and rewards in which the control and the use of the asset is transferred to the other person or to the lessee. Now, your operating lease is not further classified, but your finance lease is further classified. So when we say it is further classified, we classify it as either direct financing lease or a sales type lease. So later, we will discuss what's the difference between a direct financing and a sales type lease. Don't worry guys, in your lesser accounting, since we are accounting for a lease receivable, you will always remember or you can always determine the type of the lease. The problem will tell you if that is a direct financing lease or a sales type lease. So you just need to know the rules as to a direct financing lease and a sales type lease. Okay? So before we go further, let's now discuss the different indications of a finance lease. So when can we say that there is a finance lease? So examples are the following. So it can be one of this or a combination of this. First, of course, if there is a transfer of ownership, because you know already that once there is a transfer of ownership, there is a transfer of risks and rewards. Another, there is an option to purchase. When we say there is an option to purchase, what happens is that the lessee has the option to purchase the property. Since the lessee has the option to purchase the property, then the lessee therefore has the right over the risks and rewards and eventually a transfer of the ownership. A purchase makes a transfer of ownership. So once there is an option to purchase, it is considered a finance lease. Next, if ever the lease term is for a major part of the economic life of the asset. So when can we say that the lease term is a major part? The lease term is the major part if ever 75% of the lease term covers the life. So what do we do? Lease term over your useful life. We test if ever it is greater or equal to 75%. So let's say our lease term is 8 years. The useful life of the asset is 10 years. 8 over 10 is 80%. Since it is major part, then we use your finance lease. Next, there is a substantial minimum lease payments. Substantial minimum lease payments. When we say minimum lease payments, this is equal to your present value of your lease payments. Present value of your lease payments. So whatever is the present value of the lease payment of the lessee, you already know how to compute for the present value of lease payments of a lessee. Whatever is the present value of that lease payment, we look whether it is substantial. So Present value of lease payment divided by the fair value of the asset. If ever that is greater or equal to 90%, we have a substantial minimum lease payments. Okay, so a while back, we have already discussed how to compute a lease payment, how to compute for your present value. We divide that to the fair value of the lease asset. If it's greater or equal to 9%, then we have substantial minimum lease payments. Another, if ever the lease asset is a specialized nature. If the lease asset is of specialized nature, then we can use your finance lease. When can we say that there is a specialized nature of that asset? If ever the asset is only applicable to the lessee, that is a finance lease. Okay, so the following are indications. There's transfer of ownership, there's option to purchase, there is a major part of economic life, there is a substantial minimum lease payment, and specialized nature. So generally, if you have a lease contract, you first need to determine if ever that is a finance lease or an operating lease. Once you determine it is a finance lease, you either account of the two, whether that is a direct financing lease or a sales type lease. But once you determine that it is not a finance lease, then it is an operating lease. How do we determine if ever it is a finance lease? If the following items are present. First, transfer of ownership. Next, option to purchase. Next, your major part of economic life. Next, you have your substantial minimum lease payments. And lastly, if ever it is a specialized nature. Okay, determine once there is a lease contract, if it's a finance lease, based on these five items, or not a finance lease. Once we determine it is a finance lease, we are now ready to account whether it is a direct financing lease and sales type lease. So let's dwell now on a direct financing lease and a sales type lease. So direct financing lease. On your direct financing lease, we are to measure a lease receivable. We measure a lease receivable at the gross investment in the lease. What is the gross investment in the lease? The gross investment in the lease is the total amount to be received in the lease. Since it is gross, guys, it means it is only the amount, not the present value. Clear? Okay. It is only the amount and not the present value. Next, we have your lease asset and your direct cost. Your lease asset is derecognized. Why? Because there is a transfer of ownership. So your lease asset is equal to your cost of the asset or the carrying amount of the asset plus any direct cost. Okay? Your lease asset is equal to your cost of the asset or the carrying amount plus any direct cost. Or it is equal to your present value of your lease payments. Take note, initially we measure it at gross. Subsequently, your lease asset are measured at your present value of lease payments or the carrying amount of the asset plus your initial direct cost. Okay? So to compute for your lease asset, you have two items, carrying amount plus your initial direct cost or the present value of lease payments. Receivable versus your lease asset will give you your unearned interest income. So generally, your entry here should be a debit to lease receivable. You credit the asset and then you recognize unearned interest income. Okay. The lease receivable is the gross amount of your collectibles. So whatever is the amount of lease payments at gross, then that is your lease receivable. Your lease asset is your cost of the asset plus initial direct cost. If not given, you use your present value of lease payments. The gross less present value will always give you your unearned interest income. Lease income, there is no lease income. So meaning there will be no rent income here. There will be no rent income, but we have an interest income. Why? Because as you can see, we have here your unearned interest income. So that will be based on your effective interest method. Okay. So generally, what you need to look here is your lease receivable and your unearned interest income. So once you have an interest income, let's say you have a collection, you debit cash, you credit lease receivable for your collection. And to recognize your interest income, we debit unearned interest income, we credit interest income using your effective interest method. Again, I don't have any problem regarding your computation of your effective interest method because we already covered that. What I want you again to focus on is the recognition of your lease receivable, the recognition of your lease asset. So our focus is this item. How to compute for your lease receivable at gross, and how do we compute for your asset that will be derecognized. Take note to compute for the asset that will be derecognized, that is equal to your cost plus initial direct cost. Okay? And the difference is the unearned interest income. Further, please focus on these two items. There is no lease income, but there is an interest income. So no rent income in a direct financing lease, but there is an interest income. So let's take a look into this example. So let's say this is a direct financing lease. So the carrying amount of the equipment is 2 million, the useful life is 5 years, and the annual payment beginning of the period is 467,273, and the guaranteed residual value is 200,000. The implicit rate is 12%. So what is the total interest income and what is the interest income in year 1 and the current portion and non-current portion of the lease? Okay, first, we need to compute for our gross amount. Okay? So the gross amount is equal to your total collections. So your total collections, what are the items again? Your fixed payments, your variable payments, your residual value, your penalties in the lease, if you still remember the items of a lease payment. So what are the items here? As you can see, we have an annual payment, which is for 5 years. So 5 years multiplied by 467,273. So how much is that? 5 times 467,273. We have 2,336,365. And then, what are the other lease payments that we can recognize here? So, we said your fixed payment, variable lease payment. We also have your residual value, your penalties on the lease, and regain purchase option. So in this case, we only have two. We have your annual payment and your residual value. So your residual value is 200,000. So the gross is equal to 2,536,365. So this is our lease receivable. Next, we compute for the amount of our lease asset, which is equal to your cost plus any initial direct cost, or that is equal to your present value of your lease payments. So what is the cost? That is 2 million pesos. Do we have any initial direct cost? Do we have any initial direct cost? We do not have any initial direct cost. So what do we have then? We have zero, so our lease asset is only 2 million pesos. Okay? Or that is your present value of lease payments. So we have your fixed payments of 467,273. Since it is paid at the beginning of the period, we'll use your present value of annuity due. N is equal to 5, I is equal to 12%. Further, we have a guaranteed residual value, 200,000. We use your present value of 1, N is equal to 5, I is equal to 12%. Okay, let's try to compute. 1.12, and then we have 5 periods, annuity due. Okay, so if you try to compute this, the present value, you will get 2,029,000 or 2 million itself. That's why I'm telling you that in computing your lease asset, you have two ways. If the cost is given, just get the cost, you add the initial direct cost para mas madali. Or kung gusto nyong pahirapan yung sarili ninyo, mag-compute kayo ng present value of lease payments. Okay? Yun yung technique dito. Just get first the cost plus initial direct cost. That is the amount of our lease asset. If not, then you compute your present value of lease payments. Okay. How do we recognize now these items? So lease receivable, we recognize 2,536,365, right? And then we remove your lease asset, that is equipment, at 2 million pesos. What did we say? The remainder is known as your unearned interest income. So 536,365. 536,365. Clear? Okay. Let's prepare the amortization table. So we have here your interest expense, and then your annual payment, and then we have your amortization and your carrying amount. So on January 1, year 1, what do we have? A carrying amount of 2 million pesos. Sir, why 2 million pesos? Because that is the present value, the 2 million. Okay. Once we get for the 2 million, we amortize it for 1 year kasi at the beginning of the period. So annual payment of 467,273. So we have here negative 467,273. So 2 million less 467,273. We have 1,532,727. So let's say January 1, year 2. So our interest expense from 1,532,727, we have here 12%, right? So times 12, we have 183,927. And our annual payment is 467,273. So the amount of our amortization is 283,346. So our carrying amount therefore is 1,532,727 less 283,346, 1,249,381. Okay. So the total interest income, if ever that is the question, this means the unearned interest income. We have already computed that. That is 536,365. Interest income in year 1, we have already computed that. This is income, by the way, because it is lease receivable, 183,927. The current and non-current portion of the lease, you already know that. If this is the carrying amount, if this is the carrying amount, this is the current portion, and the non-current portion is this amount. Okay? I hope you don't forget how to classify the current and non-current using your amortization. Okay, so here, let's recap. In a direct financing lease, you just need to recognize a lease receivable and your lease asset. Your lease receivable, you recognize that is equal to your gross amount of your lease payments, gross lease payments. Your lease asset can be computed in two ways. That is equal to your cost plus any initial direct cost or the present value of your lease payments. So please do not forget what are the items of a lease payments. The difference between your lease receivable or your lease asset is equal to your unearned interest income. For your interest income, I don't have any problem with that. We use your effective interest method. Current and non-current, you already know that one. Another example. So the carrying amount of the equipment is 2 million. The useful life is 5 years. The annual payment, beginning of the period is 495,381. Direct cost is 65,687. Implicit rate is 10%. So first, we need to compute for your gross lease payments. Your gross lease payments, here, as you can see, what we only have is annual payment. So the only Lease payment here is the annual payment. So we have 495,381 times 5. 495,381 times 5. We have here 2,476,905 as the amount of our lease asset. Okay. As the amount of our lease receivable. So our lease receivable is equal to 246,795. Next, we compute for the amount of your lease asset. You just need to get the cost or the carrying amount plus the initial direct cost. So the carrying amount is 2 million. The initial direct cost is 65,687. So how much then is our amount of lease asset? 2,065,687. So take note, this lease asset is also known as the present value of the lease payment. If this is the gross lease payment, this is the present value of your lease payment. Okay, and the difference between the two is known as your unearned interest income. So what is the unearned interest income? The unearned interest income is equal to 411,218. 411,218. So if we try to amortize it again, interest income, we have your lease payments, we have your amortization, and the carrying amount. So on January 1, year 1, what is the present value? We have 2,065,687. And then we have an initial lease payment because it is made at the beginning of the period, 495,381. So what is the carrying amount? Our carrying amount is equal to 1,570,306. And then on December 31, year 1 or January 1, year 2, our interest income is equal to 1,573,06 times 10%. We have 157,031. 157,031. Our lease payment is 495,381. Then our amortization is equal to 338,350. So our carrying amount after our amortization is 1,231,957. 1,231,957. So if the question is interest income, year 1, 157,031. Total interest income, this talks about your unearned interest income, 411,218. The current and non-current portion, if this is the carrying amount, the current again is this one. And the non-current portion is this one. Okay? So see, you just need to know this. Your gross lease payments versus your lease asset will give you your unearned interest income, direct financing lease. Since you're done with your direct financing lease, let's proceed to another type of your finance lease. Because we said your finance lease can either be a direct financing lease or a sales type lease. So we go now to your sales type lease. So in your sales type lease, you lease your asset in the form of, you sell your asset in the form of lease. So in selling the asset, you enter into the lease instead. So since this is sales type, you need to recognize a profit. We need to recognize a profit. So how do we recognize for your profit? First, you need to compute for your revenue. You need to compute for your revenue. That is the fair value of the underlying asset, or if lower, the present value of your lease payments. And then we have your cost of sale, that is your cost or carrying amount of the lease asset. Your profit is equal to your revenue less your cost of sales, of course, and your initial direct cost is considered as an expense. So as you can see a while back, initial direct cost under your direct financing lease is included in the cost of the lease asset. Here, it is considered as an expense. Here, it is considered as an expense. So perhaps what we need here is to compute first on these revenues and your sales. and your cost of sales. So your revenue is also known as your sales, and your cost of sales is known as your cost of the lease asset. So take note, a while back, we learned that your present value of lease payments is the lease asset. Here now, your present value of your lease payments is considered as the revenue. So kumbaga, we have here your gross lease payments. This is the amount of our lease receivable. We have your present value of lease payments or your lease asset. Now it becomes your revenue or your sales. And then we have another one, your cost of sale. Your cost of sale is the carrying amount of the lease asset. Okay. However, there are certain rules as to your residual value in the sales type lease. So what are those rules? So take note, your residual value can either be guaranteed or unguaranteed. When can we say it is guaranteed? It is considered as a guaranteed residual value if at the end of the lease, the lessee will pay the amount of the value of that particular asset at the end of the lease term. And guaranteed if ever the payment of the particular residual value or the amount of the residual value is not guaranteed by the lessee or any other person that is qualified by the lessee. Now, what is the treatment? So whether it is guaranteed or unguaranteed, you know that it is included in your lease receivable. Okay. When we talk about your lease receivable, we talk about your gross lease payments. What are the items of your gross lease payments? First, we have your lease payment, your annual lease payment, any variable lease payment, any bargain purchase option, any residual value, and any lease penalties. Okay? So those are the items. So your guaranteed or unguaranteed will always be included in the lease receivable. However, for guaranteed, it is included in the amount of your sales. In the guaranteed, it is included in the amount of your sales. While your unguaranteed is included in the cost of sales. Therefore, to compute for your sales, sales is equal to your present value of your lease payments plus your present value of your guaranteed residual value to compute for your sales. While to compute for your cost of sales, we have your carrying amount or cost of the item sold less your present value of unguaranteed residual value. Take note, PV included in sales, PV included in sales, that's why we add here. Next, PV deducted in cost of sales, that's why we deducted here. Take note, unguaranteed is deducted in your cost of sales and your guaranteed is included in your sales. Either way, guys, whether guaranteed or unguaranteed, you will have the same dealer's profit. Either way, whether guaranteed or unguaranteed, you have the same dealer's profit. Let's have an example on your sales slide, please. Okay, so let's assume this is a sales type lease. So the useful life is 5 years, the lease term is 5 years. The annual rent payable at the end of the term is 500,000 per year. The interest rate implicit to the lease is 12%. The residual value is 150,000 and the initial direct cost is 30,000 pesos. First, we need to get for the gross lease payments. So, of course, you have your annual lease payment and we have your residual value here. Why? Because only those items are the lease payments, but we have 5 items should have been. But since only the residual value is given, yun lang yung dadagdag natin. So annual lease payment, gross 500,000 for 5 years, that is 2.5 million. And the residual value is 150,000. This is 2,650,000. Next, we get for your sales. How to compute for your sales? This is the present value of your lease payments. So we get the present value of your 500,000. So since it is paid at the end, present value of our ordinary annuity of 1, n is equal to 5, I is equal to 12%. the residual value, we get the present value of 1 n is equal to 5i is equal to 12%. Okay? So first, we need to compute for our present value of our annual lease payments. So 1.12, 5 years. So our present value of annual lease payment is equal to 1,800,000 to 388. Next, we get for the present value or of your residual value. So present value of 1 and is equal to 5. We have 85,114. 85,114 plus 100, 1,800,000 388. We have 1,887,502. Okay, so this is the total present value. Okay, before we continue further, it is important for us to know if it is a guaranteed amount or an unguaranteed amount. Why? Because the treatment is different. Of course, the gross lease payment will remain the same, 2,650,000, 2,650,000. Now, the sales is different for the two. If that is guaranteed, how do we compute for your sales? We have your present value of your lease payments plus the present value of guaranteed residual value. While if that is guaranteed, we only have your present value of lease payments. Now, for your cost of sales, if that is guaranteed, what we only have is the carrying amount of the equipment. Okay, so the carrying amount. And then for your unguaranteed, we all have your carrying amount less your present value of unguaranteed residual value. Okay, so you need to determine whether the residual value is guaranteed or unguaranteed. So we already have determined the two. So since we are already computing this, let's first start with your guaranteed. For your guaranteed, your sales is equal to your present value of lease payments. So we have 1,802,388 plus your present value of your guaranteed residual value, 85,114. So your sales here is 1,887,502. And your cost of sales, since I failed to give an amount of your asset, let's assume that the amount of the asset is 1 million, perhaps. 1 million. Let's say 1 million. The carrying amount of the asset is 1 million. Okay. So we're done computing for your guaranteed. How about for unguaranteed? For your sales, it is only your present value of your lease payments. Your present value of your lease payment is 1,802,388. So your annual lease payment only was included here. And for your cost of sales, we have your 1 million less the present value of unguaranteed residual value, that is 85,114. 1 million less 85,114 will give us 914,886. Okay? So after computing the present value and after computing the sales and the cost of sales, we are now ready to compute for our items of unearned interest income and also items of your profit. Okay, I'll just move it here. So we have here sales, lease payments, and then cost of sales. For guaranteed, how much is our lease payments? 2,650,000. 2,650,000. For your sales, we have here 1,887,502 and 1,802,388 for your unguaranteed. Your cost of sales, 1 million for guaranteed, and how much? 914,886 for unguaranteed. So after those, we are now ready to compute. So the sales versus the uh, cost of sales will give the sales versus the lease payments will give us your unearned interest income. This will give us your unearned interest income. And then the difference between your sales and your cost of sales, we have your, I know, sales versus your cost of sales will give you your unearned interest income. And then your lease payment versus your sales, we have your uh, profit. So let's make our entry first. So we're done computing, guys. We're done computing. I'll just erase these items. Let's make our entry. Okay. So for your guaranteed, we make an entry for our lease receivable, 2,650,000 pesos. So our cost of sales here in your guaranteed is still 1 million pesos. We have recorded a sale amounting to 1,887,502. And then we remove our inventory, that is the cost of sales, 1 million. So 2,650 versus 1,887,502. How much is our unearned interest income? Okay. Unearned interest income, dealer's profit. So 2,650 less 1,887,502. We have 762,498. If that is unguaranteed, your lease receivable will still be 2,650,000. Your cost of sales is now equal to 914,881. Your sales is equal to 1,882,388. And then your inventory, we remove it at 1 million pesos. So what is our unearned interest income? It's still 762,498. Okay? It's still 762,498. So as you can see, uh, if we try to compute, you will still compute for your same unearned interest income. So whether or not, guys, whether or not it is guaranteed or unguaranteed, you will get the same unearned interest income. So our unearned and interest income is 762,498 for both items. The amount of sales differ. For guaranteed, we have 1,887,502. For unguaranteed, we have 1,882,388. Next, for your cost of sales. For your cost of sales, we have 1 million for guaranteed and 914 for 914 881 914 881 for our 914 881 for our unguaranteed. Now we go with your dealer's profit. So for your dealer's profit, to compute for it, this should be 1802 lang pala, 1802. For your dealer's profit, we have your sales less your cost of sales. So our sales is equal to 1,887,502 and then 1 million for your guaranteed. So your profit here is 887,502. And for your unguaranteed, we have your sales amounting to 1,802,388, but our cost of sales is 914,388. You will still get 887,502. I told you, whether it is guaranteed or unguaranteed residual value, you will get the same unearned interest income and dealer's profit. The computation of your sales and cost of sales will only differ. So we will still get the same dealer's profit. By the way, if ever you are asked for dealer's profit, don't forget you have additional expense here, which is the initial direct cost, 30,000 pesos. So you deduct it, you have 857,502. 857,502. Okay? So take note, we are to compute three items here. First, your gross lease payments. Next, your sales, which is the present value. And then we have your cost, gross lease payments versus sales. You have your unearned interest income. Sales versus cost, we have your gross profit on sale. But if the question is dealer's profit, you need to deduct further expenses. Next. And last topic, your lessor operating lease. So if it's not a finance lease, your finance lease is either direct financing lease or a sales type lease. Then it is an operating lease. If it's an operating lease, instead of recognizing interest income, you will recognize here rent income. So you have a revenue known as your rent income. And you also have an expense known as your depreciation. Sir, why do we have a depreciation in your operating lease but none in your finance lease? Take note, in your finance lease, the asset is derecognized. Since it is derecognized, no more depreciation. Here, it is still recognized. Therefore, there is a depreciation. So you have the rent income and at the same time, depreciation. Further, initial direct costs in an operating lease is added to the carrying amount of the asset. Added to the carrying amount of the asset. Okay, let's have a recap of everything. So we have here your lessee and your lessor. Let's start first with your lessee. Your lessee, as a general rule, will apply finance lease. So in computing for your finance lease, we recognize two items, right of use of asset and a lease liability. Your right of use of asset is equal to your lease liability plus your initial direct cost plus your dismantling cost less lease incentives. Your lease liability is equal to your present value of lease payments, which is discounted using the incremental rate that is implicit to the lease. So implicit to the lease, and your borrowing rate of the lessee, if ever the rate implicit to the lease is not given. Subsequently, your right of use of asset, you have a depreciation, and your lease liability, you have an interest expense. And as an exemption to this rule, only if ever we have a low value asset or a short-term lease. So what do we have here? We have a rent expense. Now, in accounting for your lessor, we have either your finance lease or your operating lease. So remember, when do we consider it as a finance lease? Our mnemonics a while back is TOMS 2. So first, transfer of ownership. O, option to purchase. M, major part of the asset. S, substantial amount of minimum lease payments. And another S, that is for specialized nature of the lease asset. Once these items are present, then we have a finance lease. And your finance lease is either a direct financing lease or a sales type lease. In a direct financing lease, we have to compute for your gross amount of your lease payments. This is known as your lease receivable versus the cost of the asset, which is equal to your carrying amount plus initial direct costs or the present value of your lease payments. So the difference is your unearned interest income. Over the time, you need to recognize your unearned interest income. Next, in your sales type lease. In your sales type lease, we need to compute for your gross lease payments. This is the lease receivable. We need to compute for your present value of your lease payments. This is equal to your sales And we need to compute for your cost. This is the carrying amount of the inventory. Lease receivable versus your sales will give us your unearned interest income. Sales versus your carrying amount, we have your gross profit. How to compute for your sales again? We have your present value of your annual lease payments, and also you need to add the present value of your guaranteed residual value. For your cost, how do we compute? That is the cost of the inventory less the present value of unguaranteed residual value. Okay, so take note, guaranteed is added on the sales, unguaranteed is deducted in the cost of sales. Further, you will still recognize unearned interest income. Take note, whether it is guaranteed or unguaranteed, you will have the same total amount of unearned interest income and the same amount of your gross profit. Now, for operating lease, you will only recognize a rent income over the lease term, and at the same time, you will continue to depreciate. However, in your finance lease under the lessor, you will not depreciate. Okay, so these are the rules that we have discussed under your lease. To take note, your lease is a mixed account. We need to recognize both a receivable and a liability. So the lessee will recognize a lease liability, while the lessor will recognize a lease receivable, dependent on whether the lessor has a direct financing lease or a sales type lease. Okay, so that's it for our lease accounting.